All right, let's jump right in because this isn't just another routine tax year. We're dealing with an entirely new legislative framework. And honestly, the rules of the game have fundamentally changed. Whether you're a salaried employee, a freelancer, or running a small business, sticking to your old filing habits could be incredibly dangerous this season. So in this explainer, we're going to demystify the absolutely critical updates and those costly mistakes you need to avoid when filing your income tax return for assessment year 2026-27. Now, you might be wondering, what's the big deal this year? Well, the structural overhaul of the new 2025 Act, combined with the Income Tax Department's massive new AI data matching prowess, means a simple error won't just delay your refund anymore. It's going to trigger immediate scrutiny. We are officially moving away from an era where the tax department would just occasionally audit a few returns. Now, we're in a system where an advanced algorithm is instantly cross-referencing every single claim you make against a literal mountain of third-party data. To get us safely through this minefield, we're going to follow a quick 5-step roadmap. First up, the AY 2026-27 tax landscape. Second, choosing the right ITR form. Third, reconciling your AIS and Form 26AS. Fourth, reporting hidden foreign assets. And finally, avoiding final submission traps. Let's get to it. Starting right off with step 1, the AY 2026-27 tax landscape, or as I like to call it, the invisible watcher. Okay, so the crucial point here is that even though you're filing for income earned back in FY 2025-26, mistakes made in this transition year carry way heavier consequences. Why? Because the invisible watcher, the tax department's AI, already knows your financial footprint. The new act actually consolidates and renumbers the old sections, which means if your CA firm or your filing software is using outdated versions, you are going to hit immediate validation errors. The department isn't just looking at what you declare anymore, they're using advanced data analytics to look at exactly what you forgot to declare. Moving on to step 2, choosing the right ITR form. This is literally your first crucial step. Look, if you stumble right out of the gate by picking the wrong form, boom, your return becomes defective instantly. If you leave that unfixed, it's treated as if you never even filed, and that means lost deductions, lost refunds, and some pretty steep penalties. Your specific financial profile dictates your form. So if you're a resident individual making less than 50 lakh rupees purely from salary and one house property, you're totally safe with ITR 1, also known as Sahaj. But the second you have capital gains from selling shares or mutual funds, or you own unlisted equity or have multiple houses, you must use ITR 2. Running a business or working as a freelancer, you need ITR 3. And if you're taking advantage of the presumptive taxation scheme to just declare a flat percentage of your turnover, you're looking at ITR 4, or Sugam. You've got to choose wisely here because this sets up your entire filing journey. All right, step 3, reconciling your AIS and Form 26AS. Time to formally meet the AI. You know, there is a super dangerous gap between relying solely on your employer's Form 16 and the massive web of financial data the AI has already collated in your annual information statement. The days of simply copying the numbers from your Form 16 and hitting submit, yeah, those are entirely over. Your employer only knows what they paid you. The AI, on the other hand, knows about the interest from that tiny fixed deposit you totally forgot about, your mutual fund dividends, property transactions, and even foreign remittances. If what you report doesn't match what the AI sees, the system flags it automatically. No questions asked. So, what happens if you spot a mismatch, like maybe a duplicate entry or the wrong TDS credit? Don't panic. The system has errors sometimes. Maybe TDS got credited at the wrong PAN or transaction got recorded twice. You just need to follow a few simple steps. Log in, download your AIS and your Taxpayer Information Summary, or TIS, which gives you a simplified, category-wise summary of your info. Find those errors and hit Submit Feedback to tell the department that the information is incorrect or duplicated. You absolutely have to do this before you file, or you might end up paying taxes on income you never actually earned, and nobody wants that. Let's dive into Part 4, Reporting Hidden Foreign Assets. These are some truly deep traps. Okay, listen up on this one. Schedule FA. Even if you haven't sold those foreign company shares or received any dividends, failing to disclose them can attract severe penalties under the Black Money Act. With more and more people investing globally or working for MNCs, this is a trap catching thousands of people off guard. There's this massive misconception right now where employees believe that because their restricted stock units haven't vested yet, or because they haven't cashed them out, they don't need to report them. Well, the law honestly doesn't care if you've made a profit yet. If you hold the asset, it goes on Schedule FA. Period. 10,000 rupees.
Yup, that is the exact penalty you're going to face for failing to disclose even a single dormant, zero-balance business bank account under the new mandatory Field E21 in ITR 4.
Whether it's a current account, an overdraft, or even just a UPI-linked bank balance used for business, the AI expects an exact match for your March 31st balances. Previously, folks filing ITR 4 under presumptive taxation only had to report 4 basic items, like debtors and cash in hand. Bank balances were completely optional. Well, not anymore for AY 2026-27. You now need to aggregate every single active business account, and yes, that includes your Google Pay or PhonePay linked business accounts, and put that combined closing balance into Field E21. Miss just one account, and that 10,000 rupee penalty applies instantly. Now, what's really interesting here is this expert warning. Despite all this digitization, you cannot blindly outsource your compliance to third-party AI tools without human review. We're seeing a huge trend of people bragging online about having an AI chatbot do their taxes to save on expert fees. But here's the catch. An AI tool might completely misinterpret the complex grandfathering rules that exempt your older investments from certain taxes. Or it could miss the mandatory Form 10IEA that you need if you want to opt for the old tax regime instead of the new default one. When you're dealing with complex returns, an expert human eye is still for sure your best defense against an AI-driven audit. And finally, step 5, avoiding final submission traps and safely crossing that finish line. Look, doing all this hard work and hitting submit is basically meaningless if you forget to e-verify within 30 days. Or if you just throw away the rent receipts you'll inevitably need when the tax department asks for proof years down the line. You've done the hard work, so don't trip over the finish line. An unverified return is an invalid return. And regarding documentation, gone are the days when you could claim HRA or medical insurance deductions without proof and just get away with it. You absolutely must retain your rent agreements, the landlord's PAN, and your donation transaction references. The department's analytics can so easily flag an unusually high deduction and ask for proof 2 years from now. So hopefully this explainer has equipped you to navigate the AY 2026-27 landscape safely. But it does leave us with a pretty big question. Is your record keeping truly ready for the long-term memory of the new tax regime? Actually, think of it this way. You're no longer just filing a form. You're submitting a data point into a highly sophisticated surveillance network. Make absolutely sure your data is accurate, your forms are correct, and your paper trail is bulletproof. Thanks so much for joining me on this explainer, and hey, happy filing!